Hello and welcome to this video on profitability ratios. Businesses exist to make a profit. So when we're evaluating the performance of a business, often we look at the profit first up. Profitability ratios help us to analyze how the business made a profit and how efficiently and effectively they've used their resources to generate the profits. The most important profitability ratio that we'll ever hear about is the return on equity. Investors care about the return on equity because investors put equity into the business and they want a return on their money. That's why they're investing. The return on equity formula is the firm's net profit divided by the average owner's equity. It's going to be expressed as a percentage, and it tells us how effectively the business is using shareholders' money to generate returns for them. Here's an example of the return on equity formula in use. I save $1 million and I buy an apartment in Sydney. After 4 years' time, I decide to sell that apartment and I sell it for $1.2 million. That means my owner's equity would have been $1 million, my profit would have been $200,000, and my return on equity, my net profit, $200,000, divided by my equity of $1 million equals 20%. If I change the way I structure this transaction a little bit, I might get a different return on equity. So if I decide to save up $500,000 and I borrow $500,000 from the bank at 3% interest, I can still buy that same $1 million apartment and sell it for $1.2 million 4 years later. However, this time my return on equity is different. My owner's equity was only $500,000. I made a profit of $140,000, the $200,000 sales price difference minus the $60,000 interest expense, and my ROE is 28%. So in this case, I had the same business operations. I bought the same house for the same price and sold it for the same price in both examples. However, my ROE or my return on equity varied greatly depending on how I financed the business. So the lesson here is that the return on equity is influenced by both the business operations, what I bought and sold, and how the business was financed. Did I use debt or equity to finance my assets? Because the return on equity can be so easily varied by the amount of leverage we use, we're also going to look at the return on assets, ROA. The return on assets is the firm's net profit divided by their average asset balance. If we run through the same example of buying an apartment in Sydney, in example A, my return on assets is 20%. I made a $200,000 profit divided by my $1 million asset value to get an ROA of 20%. In example 2, I still had that same asset value of $1 million. However, this time my profit was a little bit less. It was only $140,000 because I had to pay an interest expense. So my ROA would only be 14%. This example shows that the financing effects on ROA are not the same as on ROE. Using leverage will not increase your return on assets formula. It's more likely to decrease it because you incur an interest expense that lowers your return. So how do we analyze our ROE and ROA figures? Well, if all things are equal, higher numbers are better because it indicates that we've generated higher profits for our given asset or equity investment. However, risk and return are related. Higher returns are not always better if the business took on more risk. So how do we know what's a good return or not? Something that's too low would be if the return are lower than the interest rates. So if you invest in a risky business and you're only generating a 1 or 2% return, you're not going to be happy with that. Your money's better off in the bank earning a higher return in a much safer environment. A normal business return for a stock market listed firm is around 7 to 15%. High would be 15% plus. Apple have generated over 20% for many years, which is phenomenal performance. Too high, the spam email offers you see offering 100% returns. Too good to be true. Very, very risky endeavors. Another profitability ratio is the profit margin. The profit margin is the firm's net profit divided by their sales revenue. And it indicates for each dollar of sale you make, how much do you actually keep as net profit after you've paid off all your expenses. So it measures the ability to generate profit from the sales you make. The profit margin is heavily dependent on the business's strategy and the industry it operates in. For example, Apple have a profit margin of 21.49%, while Dell have a profit margin of only 5%. Both businesses operate in the IT industry, selling hardware. However, they have very different business strategies. Apple is a differentiated product, high profit margins, very high-end products, whereas Dell make much lower quality products, but they focus on quick turnover, low prices, and a cost leadership strategy. So it shows up in their profit margin. So when you're analyzing the profit margin of a firm, look at your own firm in prior years, think about their strategy, think about which industry they're in before you say a profit margin is good or bad. You can be a very successful business with a low profit margin. Think about your supermarkets like Woolworths and Coles, low profit margins, but still very, very profitable. So in conclusion, profitability ratios are really important. However, it depends on what your purpose of analysis is. If you're an investor, profitability ratios will be front and center on your mind. Investors care about forecasting future profitability and making sure the companies they invest in stay profitable into the future. However, if you're a bank manager and you've lent money to a firm, increases in profitability in the future may not be the most important thing to you. You may be more focused on liquidity and solvency ratios instead. So depending on the purpose of your analysis, profitability ratios may be the first and most important thing you look at, or they may be lower down the pecking order of what's important. But overall, businesses are created to make profit. So analyzing the profitability of those businesses by looking at the efficiency and effectiveness in how they generate profits is a very important skill to be able to develop.